We are still in a bull market for Bitcoin. I know we ended up in a bear market by some metrics during or right after so-called Liberation Day, early April. But Bitcoin has maintained its uptrend relative to gold, did not break. And I think that's a very, very positive thing. It's still in the bull market as our on-chain analytics led by David Puel suggest. And I do think you can say the same now about the equity markets. I really love bull markets like this because what's happening is the equity market is climbing a wall of worry. And what's been fantastic about this time around is it has not been an unhealthy bull market like it really was from 23 to 24, when the concentration towards just a few stocks was at its extremes. The market is broadening out, so it's much healthier now.
Bitcoin remains in a bull market. It held strong through the sell-off following Liberation Day in early April and stayed steady amid the fallout from Israel's bombing of Iranian nuclear site. Despite rising global tensions, Bitcoin maintained its upward trend and continued to outperform gold. On-chain data shows consistent accumulation, indicating that long-term holders and institutions are not pulling back. With growing demand from ETFs and expanding international adoption, Bitcoin's role as a long-term asset seems more solid than ever. ArchInvest CEO Cathie Wood notes similar resilience in the stock market. Despite concerns over tariffs and sluggish growth in some sectors, the rally is broadening as more industries join in, often a sign of a stable recovery. A key driver is productivity, especially from new technologies like AI, which help companies do more with less by cutting costs while boosting output. This kind of growth tends to ease inflationary pressures. Contrary to popular belief, history shows strong productivity often leads to both stable prices and stronger economic growth simultaneously. If this trend continues, upcoming surprises might not be rate hikes or deeper recessions but rather lower inflation, improved fiscal numbers, and a market that advances on solid footing. Stay tuned until the end to hear Cathie Wood's insights on why Bitcoin and the broader market could be entering one of the most transformative phases in decades.
As we believe, reaching the end of this rolling recession with some certainty on tariffs, the tax package, so the big beautiful bill, and the wars, both Ukraine and the turmoil in the Middle East, as those start clearing up, perhaps, or at least some of them. And we do believe we'll launch from a rolling recession into a rolling recovery that we think will gather momentum as we're exiting this year into next year with productivity, the big surprise, and real GDP growth benefiting. We also think the other surprise will be inflation, much lower than expected because of productivity. Now, a lot of people associate real GDP growth with higher inflation. The higher the growth, the higher inflation. If you look at history, that's absolutely wrong. The higher the growth, the higher the productivity, and productivity is a potent anti-inflationary force. And we think that's going to be the case this time, perhaps more than ever, because of all of the deflationary undercurrents associated with the explosion in new technologies, catalyzed especially today by AI, which is, as we've gone over in the past, extremely deflationary. Good deflation. The more costs fall and prices fall, the more units explode. That is how we usually exit recessions, or in this case, a rolling recession. And we think this time will be no different, except it will be more exaggerated than usual. So we think that the tide is turning here, and and we think the surprises could be on the low side of expectations, meaning the deficit shrinking as a percent of GDP more than people expect. Here you can see what I mentioned about M2. M2 is closing in on 5% growth. That's depicted in the purple line here. But if you take a look over history at this chart, you'll see that even that rate is at the lower end of what we've experienced over the years. Now, what's also interesting on this chart is in the 60s and 70s, you'll see M2 growth on a year-over-year basis was outpacing inflation. It was accommodating all kinds of government spending. And you can see that this is pushed ahead by 18 months, that if we're right, the inflation rate is going to come down. And the controversy out there, and I think what Treasury Secretary Bessent has been trying to guard against, is that we don't end up in another 70s accommodation period, which led to terrible inflation, double-digit inflation. If we're right, this environment is going to look much more like the 90s, where money growth is above the inflation rate, and actually inflation tends towards a decline. And what that will mean is that the velocity of money is slowing down. Now, the velocity of money, I know I've featured it in charts in the past, but it's been in a secular downtrend since a secular decline. The growth rate had been slowing quite a bit, but the actual decline started in the late 90s. With the occasional cyclical bump. Well, we've just been through the cyclical bump, and velocity is starting to turn down again. So that trend is important. If it's still in place, then money growth at this level is not at all a problem in terms of feeding inflation. The velocity is the rate at which money turns over. And why would it decline? Well, if we're right and inflation is much lower than expected and interest rates will follow, the attitude is, well, I don't have to rush now to buy anything because inflation and interest rates are coming down.
Money supply growth is rising again but remains at manageable levels. As of mid-2025, M2 is growing around 5% year-over-year, rebounding from the contraction seen in 2022, the first decline in over 60 years. Despite this increase, today's growth rate is still modest compared to the 10-13% expansions during post-war stimulus periods and pre-2008 credit booms. Cathie Wood points out that inflation risks stay low partly because money is moving slowly through the economy. The velocity of money, the rate at which dollars circulate, has been steadily declining since its peak in the late 1990s and is now near record lows. This means individuals and businesses are holding onto cash longer instead of spending it right away. Factors like aging populations, weaker consumer demand, and shifting savings toward investments rather than goods all contribute to this slower money movement. If inflation continues to cool and interest rates fall, there will be even less urgency to spend, further reducing the velocity of money and the risk of another inflation spike. Cathie believes this falling velocity, combined with rising productivity and growing Bitcoin adoption, could define the next era, characterized by disinflation and significant growth in digital assets.
I think we have been climbing a wall of worry. I mean, a lot of people expected tariffs and wars and the controversy between the Fed and the president to really shake markets up. And of course, there has been some volatility. But these are the kinds of bull markets that I think are the most durable. When the market climbs through all of that controversy, it's really signaling something. And I think the things that it is signaling are interest rates probably are coming down. And I think what many people are not focused on in the inflation statistics are the housing numbers, and they get in there with a long lag. We think that the shift or the concentration towards just a very few stocks, which was a very unhealthy bull market, that is changing, and the market is broadening out. And I think deregulation is probably one of the most important things that this administration is doing. We've been pretty consistent on this idea of we've been through a rolling recession. If you look at housing, which is actually having a little bit of a relapse today, housing plummeted in 2022 when interest rates shot up, and it has not recovered. Manufacturing has not recovered. And so we do believe that they will recover as interest rates come down, deregulation takes hold, some certainty about tax cuts and so forth occur, including immediate expensing, perhaps, of capital goods, which would be very positive. So we think we'll move from a rolling recession into a recovery. But what happens early in a recovery, if you will allow me to call this that. I know many people think we never went into any kind of slump, but we have, sector by sector. What typically happens when you come out of a recovery is productivity kicks in because companies have been very conservative and especially amid all of the uncertainty. So productivity kicks in and actually drives inflation down much lower than anybody anticipates. And I think that's going to happen this time as well, which is not normal. And you can see how abnormal it has been. We've had that inversion in place pretty much since the Fed started jacking interest rates up dramatically, the most dramatic move ever in percentage terms, in percentage change terms, and it's been inverted ever since then. And this is one reason we believe we've been in a rolling recession, and the headline numbers obfuscate this rolling recession. But if you go sector by sector, manufacturing down and out, housing down and out, small businesses constrained by all kinds of metrics, monetary policy is too tight. So here is real GDP versus productivity. Real GDP is in the purple, and you can see how this rolling recession has been obfuscated, I think, holding real GDP growth up over the last few years as housing has crashed and manufacturing has really been under a lot of stress, has been the government sector, and now that's starting to give way, and the high income part of consumer. And we know from sentiment indicators that their sentiment has diminished as well with all the uncertainty around tariffs and geopolitical risks. So we think the bias here in this number is down. You can see on a year-over-year basis, even during recessions, look at the early 90s, that was the S&L recession. It barely went down. In the tech and telecom bust, it didn't go down. We needed two shocks, the global financial crisis caused by mortgages and COVID to get it down in any big way. You can also see productivity. You can see how it picked up in the 90s. One of the reasons that, as the internet was taking off, one of the reasons inflation did stay very low. And you can see it has been languishing at a fairly low level relative to what we enjoyed during the late 90s. We think we're going back to that level and well beyond in a secular sense.
According to Cathie's data, we may be entering a phase where lower inflation combined with improved productivity supports growth without causing the economy to overheat. This shift has the potential to reset investor expectations across the board. Bitcoin fits neatly into this picture as well. With liquidity returning and traditional assets appearing stretched, Bitcoin is well positioned to capture the next surge of institutional demand. If risk appetite increases and interest rates decline, capital could flow into Bitcoin faster than many anticipate. If Cathie and her team's outlook proves accurate, this would set the stage for a realignment, one where efficiency improves, inflation eases, and digital assets like Bitcoin secure much larger roles within long-term investment portfolios. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.